You think you own gold. You opened your trading app, you typed in GLD, you hit buy. You see the little line go up and down with the price of gold, and you feel smart. You feel safe. You've been tricked. What you own is a piece of paper, a digital promise, a ticket in a very, very long line. And if there's ever a real crisis, the kind you bought gold for in the first place, that ticket might be worthless. This is the only video you will ever need to understand the paper gold trap. And by the end, you will know whether you actually own your gold or if you just own a dangerous illusion. So what's the core mistake? Why does everyone get this wrong? Convenience. The system made it easy to buy gold on your phone, so you did. They made it cheap, so you didn't ask questions. You bought a gold ETF, an exchange-traded fund, and assumed it was the same as holding a gold bar in your hand. It's not. Not even close. You didn't buy the asset. You bought a derivative of the asset. You've placed a bet on the price of gold, but you've done it inside the very casino you were trying to protect yourself from. And the casino always has the edge. Let's break this down. There are only two types of gold in the world, the real and the abstract. First, physical gold. This is simple. It's a coin in your hand, a bar in a vault that has your name on it. It has a 5,000-year track record of being money. It has zero counterparty risk. That's the most important phrase you need to understand. Zero counterparty risk. It means its value doesn't depend on a CEO's promise, a bank's balance sheet, or a government's ability to pay its debts. You hold it, you own it, end of story. Even the world's central banks call it a Tier 1 asset, the same as cash, because it's the ultimate foundation. Then there's paper gold. This is everything else. It's a catch-all term for a whole menu of financial products. ETFs like GLD, futures contracts, unallocated accounts, even gold mining stocks. They are all just promises. Paper contracts designed to track the price of gold. But tracking the price is not the same as owning the asset. Why does this matter? Because every single form of paper gold comes with that thing physical gold doesn't have, counterparty risk. Think of it like this. Owning physical gold is like having $1 million cash in a safe that only you can open. Owning a gold ETF is like having a coat check ticket that says good for $1 million coat. In normal times, the ticket works fine. But what happens if the coat check company goes bankrupt? What if they issued 100 tickets for every one coat they actually have in the back room? When everyone rushes to the window at once, in a panic, in a crisis, they find out they don't own a coat. They just own a ticket, a promise. And that's the hidden mechanism. The entire paper gold market is a chain of promises. Take the biggest gold ETF in the world, GLD. You buy a share. You think you own gold. But what do you actually own? The prospectus, the legal document nobody reads, tells you you own a fractional, undivided, beneficial interest in a trust. The trust owns the gold. And who manages the trust? The Bank of New York Mellon. And who holds the gold for the trust? Two of the biggest banks on the planet, HSBC and JP Morgan Chase. You haven't escaped the banking system. You've just wrapped your money deeper inside of it. Your safe haven asset is sitting in the vault of the very institutions you're trying to hedge against. It gets worse. Let's look at the fine print. The secrets they hide in plain sight. Secret number 1. You can't get the gold. The GLD prospectus is crystal clear. Retail investors are not allowed to redeem their shares for physical metal, period. The only ones who can are called authorized participants, basically massive financial institutions, and they can only do it in blocks of 100,000 shares at a time. So your 10 or 100 or even 1,000 shares, they're not a claim on gold. They're just a token you can sell to someone else on the stock market for cash. You own the ticket, not the coat. Secret number 2. The price is a game of leverage. The price of gold you see on TV isn't set by people buying coins. It's set in the paper futures market on an exchange called the COMEX. And this market runs on insane leverage. A trader can put down a small margin to control a massive amount of gold. But the real leverage is systemic. For every single ounce of physical gold sitting in the COMEX vaults available for delivery, there can be 50, 100, even 200 paper claims for it. The entire market is a fractional reserve system, built on the assumption that nobody will ever actually ask for the physical metal. It's a confidence game. And if that confidence ever breaks, the price of paper could go to zero, while the price of physical gold in your hand goes vertical. Now, are all paper products this bad? No, some are better than others. Compare GLD to another fund, the Sprott Physical Gold Trust, ticker PHYS. On the surface, they look similar, but their structure is fundamentally different. Difference 1, Redemption. With PHYS, you can redeem your shares for physical gold. There are minimums, yes, but the right exists for the investor, not just for a handful of giant banks. This keeps them honest. Difference 2. Custody. GLD stores its gold with HSBC and JP Morgan in London. PHYS stores its gold with the Royal Canadian Mint, a government corporation completely outside the commercial banking system. Less counterparty risk. Difference 3. Taxes. For U.S. investors, gains on GLD are taxed as collectibles at a high 28% rate. Because of its structure, gains on PHYS can qualify for the lower long-term capital gains rate of 15 or 20%. PHYS is a better-built vehicle, but it's still a vehicle. It's still a paper claim. It's a much better coat check ticket from a more reliable company, but it's still a ticket. It's not the coat. So what's the action plan? It's simple. You have to decide why you are buying gold. There are only 2 reasons. Reason 1, speculation. You just want to bet on the price. You think gold is going from $2,000 to $2,500 in the next 6 months, and you want to capture that gain. For this, paper gold is the right tool. It's cheap, it's liquid, it's easy. Buy GLD, trade futures. It's fast and efficient, but do not fool yourself. You are not buying insurance. You are a speculator making a trade. You are accepting all the counterparty risk because your goal is short-term profit, not long-term survival. Reason 2, insurance. You are buying gold to protect your wealth, to preserve your purchasing power if the system cracks, if currencies devalue, if banks shut down. Your goal is not to get rich, it's to not become poor. For this job, physical gold is the only option. Paper gold is part of the system you're insuring against. Owning GLD in a financial collapse is like owning fire insurance from a company whose headquarters is already on fire. The premium you pay for a physical coin over the spot price, that's your insurance premium. The cost of a safe or a depository account, that's the cost of true ownership. It's the price you pay to exit the casino completely. So if you've decided you need insurance, here's the final playbook. First, find a reputable dealer. Look for companies with long track records and memberships in industry groups like the Professional Numismatist Guild. Avoid anonymous sellers on eBay. Second, buy common, recognizable bullion. 1-ounce American Gold Eagles, Canadian Maple Leafs, or simple gold bars. Don't get distracted by rare collectible coins unless you're a collector. You want liquidity, not a hobby. Third, figure out storage. A high-quality, bolted-down home safe is an option, but you must get a separate insurance rider. A bank safe deposit box is better, but it's still in the banking system. The professional option is a private, insured depository that holds your metal as segregated and allocated, meaning your specific bars are sitting on a shelf with your name on them. This is how you truly own gold. Stop confusing convenience with safety. Stop confusing a ticker symbol with a tangible asset. Look at your portfolio and ask the hard question. Am I a speculator or am I an insurer? The answer will tell you everything you need to know. It will tell you whether you own a rock-solid asset with a 5,000-year history or just a paper promise that could vanish when you need it most. Choose wisely.